Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. And today I wanted to talk to you about, we talk a lot about right now is a great time for a home buying opportunity. Well, there's a lot of information out there about a lot of other things, especially if you own your home and you have some equity in your home. It would be actually a great time for a lot of people, not everyone, but for a lot of people to think about a cash out refinance. Now, I know interest rates aren't as low as they were, but they are trending down. And when you take a look at the Fed's fund rate that's been going up, 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 and up, that affects things like your credit cards, your car loans. And a lot of times when you're dealing with that type of credit, it gets adjusted like with credit cards. And with that Fed's fund rate. So what does that mean for you? Well, because it's costing the banks more, so they're going to charge you more basically to have that sort of credit. So right now is a great time to also look at a cash out refinance. A lot of people maybe have a lot of money in credit card debt because they're falling behind with all the inflation and the higher interest rates and stuff. Well, by consolidating, one way of looking at this is you're taking all of those higher interest rates, let's say, 20% or more, or, in some cases, maybe a little less, but you're bringing it down to, a lower interest rate, kind of consolidating all those cards. Be a great way of lowering the payment, helping you pay off the debt faster. Let's take a look at an example. I'm going to share my screen with you here. And this is actually a little example on this type of scenario with a cash out refinance right now. And I am going to play this for you if I can get around this. Okay, there we go. Take a listen to this. And then I'm kind of breaking this up into two parts, but take a look at this and see what you think. And these are just the pure numbers versus what you're doing now, maybe with high interest rate credit cards, car loans, all those sorts of things, versus doing a cash out refi and getting a lower interest rate and easing you on the payment. You can always pay more on the payment. You can even look at paying more on your equity or your mortgage payment. So let's take a look at this by pulling the equity out of your home with a cash out refinance, what that would kind of look like.
Look at the savings rate. It was roughly at 10% pre-pandemic. We got the first stimulus check and people couldn't spend it because everything was shut down due to the pandemic. So people put it in the bank. But at the same time, we reached an all-time high at the time in credit card balances. So now people were using that stimulus money to pay down their credit card debts. But now that everything had started to open back up and we got a second stimulus check right around Christmas time, people spent it faster than the first one. Then we got another one in March and spent it even faster than the first two. But now that that stimulus has run out and we've gotten used to that stimulus money and stimulus lifestyle, people are keeping the party going. They were depleting their savings and they were putting their spending on credit cards, bringing us to a new all-time high in credit card debt. But it's a double whammy because a year ago, the average rate in credit cards was about 14%. Today, it's 20%. Also, take a look at car loans. The average car payment is about $800 a month. It's doubled in the last 3 years. And 17% of people have a car payment over $1,000. And that's understated. It would be even higher, but now everybody's taking out 6-year car loans rather than 5. But at the same time, home equity is at an average of 58%. Comparing that to the time of the housing bubble, it was at 19%. So people have all this money in their home and all this debt. You don't buy the argument that people have a 3% mortgage rate and they should stick with it. They're paying 9% on their HELOCs, 12% on their car loans, and 20% on their credit cards. In aggregate, it's much higher than 3%. So what's the best way to show this stuff?
Okay. So that kind of sets things up for you. And then, kind of what I was talking about, where you might be at this point, where a lot of people are. And then here's kind of the second part of it, kind of breaking the numbers down. So if you have, the high credit, high interest rate credit cards with the Fed fund rate going up and the bank's charging more, car loans, whatever kind of loans we're talking about, outside of the actual mortgage, because the Fed's fund rate, it indirectly may do things to mortgage rates, but not quite directly. But inflation drives mortgage rates. So, even though we're seeing higher mortgage rates right now, they're trending down. They're going to be trending down even more in the next month or two. But this is a great way of doing a cash out refi, being much lower than what most people are going to be paying on their credit cards or car loans. So that's been set up. And then this is a way to look at the numbers and look at how consolidating this and driving down that debt cost even quicker for you.
So take a scenario. The borrower currently has a rate of 3%. The market rate is 6.5%. They bought a $500,000 home with a $400,000 mortgage. And since then, the home value has gone up. And through normal amortization, they paid their mortgage down. But today they're getting a 6.5% rate and $4,000 in closing costs. So this doesn't make sense to them. They're going to pay an extra $577 a month, but they have debt. The car payment, $700 a month, is less than the average car payment. But this debt picture in general is not out of the ordinary for many people out there. So they started with an 80 LTV, but today, because of normal appreciation and amortization, they're at a 55% LTV right here. But we can take that all the way to 75% cash out. And this white space between the 55 and 75 is the amount of cash they can use to pull, about $126,000 right here. Now, you or your customer, it's all interactive, can click on these lines, each of these lines here that represents each debt. And now you bring that LTV up, but you save them $1,100 a month. Now, what if they didn't need the extra $1,100 a month? You can take that and apply it towards principal. And by doing so, you're taking that mortgage and paying it off in 14 years and 10 months. You've saved them 10 years worth of payments, or expressed differently, 119 payments. But you don't have to wait the full 14 years to see the benefit. In just 5 years, you've built an additional $53,000. In 10 years, $138,000. And at the end of 14 years and 10 months, your mortgage is paid off and you have an additional $263,000. If you don't do this cash out refi, you have a mortgage balance in 14 years and 10 months of $263,000 at 3%. This is life-changing money.
So guys, this is a great little kind of example of the benefit right now of, rather than, again, you may not even be in need of any of this, you may be doing just fine. But for a lot of people out there right now, we just can tell, by the numbers that are out there, a lot of people having higher than usual credit card rates right now, paying more for a car payment, all that type of thing in general. If you've been getting into any new car payments or credit cards, and this inflation is really, hitting you like a lot of people, this is a great way to kind of get around that and take advantage of the equity and wealth you have in your home, which is always part of the benefit of having the options when you own property. So guys, if you have any questions at all, reach out to us. This is a great way to kind of have a hedge against this inflation. It's a way to help you and your family build wealth by owning property, having that equity, and utilizing it properly and strategically and targeted for these sorts of things. If you have any questions at all, feel free to reach out to us anytime, 480-788-8569, or MincolaHomes.com, MincolaGroup.com, and home@MincolaGroup.com. Talk to you next time.